Hey everybody, it's Spencer Hakimian. Welcome back to another episode of What's Moving Your Money. On today's episode, we have to talk about the inflation emergency that is becoming increasingly clear in the United States. We got PPI numbers in this morning and they were a disaster. They came in way above estimates, both on a monthly and on an annualized and an annual basis. Next, we have to talk about what this means for PCE, which is what the Federal Reserve actually uses to set interest rates. And finally, we're going to have to discuss that given the fact that the Fed is going to be cutting next meeting, what a mistake this might be given all the information that we now have. So sit back tight, stay tuned, and I hope you enjoy. So this morning, PPI numbers came in and they were a disaster. They were well above target. The month-over-month number came in at 0.9% versus an estimate of 0.2%. That was the highest month-over-month print since March of 2022. You have to go back to the days of the early Russian invasion into Ukraine for a number to be that significant in terms of what wholesalers have to pay in the United States. Now, even worse than that is that the annualized number came in at 3.3% year over year versus an estimate of 2.5%. So not only in the short term are we exploding over target, but on an annualized basis, we are growing so rapidly that we are missing even our annual goals. 1 month you can look through, 2 months you can look through, but on an annual basis, it's very hard to look through it. Now, look, one thing that is very important about this report is that it signifies just how much pressure is on American businesses, on American companies that are looking to produce stuff in the United States. Input costs that are coming from overseas have to get fed into prices here one way or another. Foreign nations are not eating these tariffs. We have so many data points to prove this already. It is simply nonsensical to say that a factory in China or a factory in India or a factory in Germany is paying for this. It's not. It is coming out of American companies and out of American consumer wallet. And it is only going to get worse. This, remember, was for the month of July. This report does not even account for the start of tariffs. The only tariff that was in place in the month of July were the steel tariffs and the Chinese 30% tariffs. We didn't even have the rest of the world tariffs in place. And as I keep stressing to you guys, we were able to mask some of the effects of tariffs in the short term between May, June, and so forth. Because of the fact that companies were able to front load and buy ahead extra inventory. Well, guess what? We have spent that down. It has been bought. It has been sold. It is no longer there. Any inventory hitting our shores now is now tariffed inventory going forward. So this problem is only going to get worse. And another thing that you have to know is that producer prices quickly feed into consumer prices. Why is it so important for the Federal Reserve to monitor producer prices? Because ultimately companies will protect their bottom line over everything else. And when they get a price squeeze, they are going to find ways to push that onto the consumer one way or another. They can push it via just raising their prices, or they can push it via reducing the size of the items. If you remember, shrinkflation in 2022 was maybe prices stayed the same, but the size of everything got smaller. And that is also inflation. That's just a different way of it happening to you. Now, we have to talk about the effects that this PPI and earlier in the week, the core CPI is going to have on core PCE, because that is eventually what the Fed really uses to make their calculations on what interest rates should be? Well, we already know the numbers with a very high certainty, because once you get in CPI and PPI, you can estimate with very high certainty what PCE, core PCE will be. And that estimate as of this morning is for a 0.6% month over month print. That is PCE, core PCE, running at an annualized pace of over 7%. That is nearly as bad as it was at the peak of the 2022 inflation emergency. And we've just gotten started here. We have not even felt the peak effects. Remember, in 2022, it didn't reach the peak. It started and it slowly kept getting worse. This will be exactly the same. Have no doubt in your mind about it. It will get worse before it gets better. Now, one thing that we really have to worry about is that we know the Federal Reserve is cutting rates at this point. They've told us it's happening. It doesn't seem like there's many ways around it. We are cutting into a scenario where inflation is running away from us. It is getting worse. It is a very dangerous time to be cutting interest rates. But the Fed, let's leave aside some of the partisan members of the Fed that just are auditioning to be the next Fed chair. There is one argument to be made for cutting rates, and that is that the job market is rapidly slowing. And when the job market slows, that's one side of their mandate. Eventually prices will have to come down or just, stay in place, because there will just not be enough demand for this, and it will lead to more layoffs. And then it's a nasty situation. But in theory, job layoffs do lead to disinflation and or literally deflation sometimes. So that might be happening. But please stress that in the interim, the Fed is dealing with a disaster. Both sides of their mandate are going against them at the same time. That usually doesn't happen. Usually when you get a slowdown in the labor market, inflation is falling. That's not happening here. Inflation is rising. Usually when you get a boom in inflation, you get hot demand and you get a labor market that is also growing. So we do not have that. We have the worst of both worlds at this point, and it is only going to get worse over time. I cannot stress that enough. Now, look, in the coming weeks, we're going to get more data points. We have to look very carefully, as an example, tomorrow at retail sales when they come out. Is the consumer able to continue spending into this? Because if they are, then companies can buy a little bit more time. They can wait for a new trade deal, another change in the tariff rate to happen. But if they don't, we are rapidly heading into a dangerous world here. We are heading into a world where the economy is softening while prices are rising. That is a 1970s type scenario. Look, I do not give any investment advice on a show like this, and I don't give any specific ideas, but only thing I would stress is be diversified. Be diversified across asset classes. Own positive growth assets, own negative growth assets, own positive inflation assets, own negative inflation assets, own non-US dollar assets, own neutral currencies. You want to own everything so that you can weather these hard times as they come. Yes, the stock market is doing well, but no, you do not have to take on stock market risk to earn stock market returns. And if you can avoid taking on excessive risk while not eating into your return, why not do it? So before we go here, we have to just quickly talk about one final thing as it relates to inflation. And this is that in the coming weeks, in the coming months, we may no longer be getting reliable inflation data. It's tragic, but we simply may not be getting accurate government reports any longer. One of the easiest ways to track inflation is to listen to what companies are telling you. In their earnings reports, they are very transparent in terms of price pressures, in terms of what they're seeing with the consumer. So it is of utmost importance in the coming months, quarter, and year to listen to company guidance. I will be doing extensive videos as those come along on how to dissect them. But for now, I hope you guys have a great weekend, and I'll see you guys back on Monday.